welcome to today's Market Snapshot. My name is Craig Erlam, Senior Market Analyst at OANDA. As always, let's start with a look at the markets today. And so far in today's session, we are seeing European equity markets trading around 1 to 2% higher. Broad-based gains that we are seeing so far in today's session. I think it's important to note, though, that we are continuing to trade within these the range which we've touched on over the past few weeks. In fact, we are actually trading at the upper bound of that range right now, so it's going to be interesting to see whether investors are going to push these equity indices through the upper regions of the trading range, or whether we are going to continue much in the same way that we have since pretty much the start of the month. US markets have just opened as we speak. They've opened around half a percentage point higher as well. If we look in the commodity space, we are seeing Brent crude and WTI crude trading as marginally higher. I think what we're really seeing here at the moment continues to be consolidation in the oil markets, having failed to break through the $50 a barrel level. In the currency space, we're seeing the dollar trading up around 0.3%, but I think the bulk of the moves, really, the strongest moves are coming in the pound today and the euro, which comes off of the inflation report hearing from Mark Carney and the other policymakers in front of the Treasury Select Committee, and also the data which we've had from the Eurozone, which we will touch on right now. As you can see on the economic calendar, the first thing we had today was GDP data from Germany. This was in line with expectations, strong growth in the first quarter. I do think this fed into the ZEW survey, which we had shortly after. The German ZEW survey splits into two sections. We've got the current situation and then economic sentiment. As you can see, the current situation far exceeded expectations and was much higher than the previous reading. And again, I do think this reflects the strong first quarter growth, but I do think this is a very short term viewpoint here, because as you can see, the economic sentiment, which looks further out, actually slipped to 6.4, far below expectations and the previous reading. We had a similar reading as well with the Eurozone economic sentiment figure as well, which fell to 16.8. So clearly the outlook as far as the Eurozone concerned does continue to be pretty bleak. Now, I do think there are a number of factors feeding into this, one of which being slowing global growth and global trade, which is going to be weighing on Eurozone exports. I do think the Brexit debate as well could potentially also be feeding into this as well. So we'll see how things develop over the next few months. But I think what this really does point towards is very gradual and very slow improvements in the Eurozone economy. But I think the two key events today are the UK inflation report hearing and the Eurogroup meeting from the Eurozone, of course, which we will touch on now. The inflation report hearing really did run mostly in line with expectations. It was a highly politicised event, which is quite often the case with these. We get a similar situation with the US when Janet Yellen, the Fed chair, faces the Senate Banking Committee and the House Financial Services Committee. I think this month it was increasingly, or this quarter it was increasingly politicised, because not only do we have a mix of different MPs representing different parties, but we've also now got a mix of different MPs supporting different camps in the EU referendum, which made it, like I say, increasingly politicised and piled a lot more pressure on Mark Carney and the other monetary policy makers. I think there was a couple of key points to take away from this, though, which I've noted down here. One was from comments from Mark Carney, who stated that it's not clear that it would be correct for the Bank of England to cut rates if the economy slowed after a Brexit due to the inflation risks, but on balance, leaving the EU would reduce the probability that the next move in Bank of England rates would be higher. Now, this is important because it just goes to show that the Bank of England itself is relatively uncertain about what the outcome will be from a Brexit vote. I think Judge Osborne made the comment a week or two ago that this is a really double-edged sword, and that it would appear that what we're either going to have the case of is higher inflation and slower growth, which makes the Bank of England's job very difficult, because they could either cut interest rates in order to offset the lower growth, or they can raise interest rates to offset the higher inflation. The fact that you don't know which is going to be the biggest threat after this is, I think, what Mark Carney is referring to here. So less chance of higher interest rates, just simply because at the moment that does seem to be the most likely move under the status quo. but equally cutting interest rates is not necessarily the right thing to do, because if we've got a depreciating currency which is only going to apply further inflationary pressures, then surely cutting interest rates will only add to these inflationary pressures, which means the Bank of England would not be following its own mandate. So interesting points here from Mark Carney. Another point came from Ben Broadbent, who's the Deputy Governor of the Bank of England, and he said we may get another 5% depreciation in sterling if the UK leaves the EU. Now, I'm sure anyone who's read articles recently, whether it's from Goldman Sachs or other banks or institutions or any other independent bodies, I think 5% is a very conservative viewpoint here. Most people suggesting that we could see up to a 20 to 25% decline in the pound in the event of a Brexit. Of course, not all immediately, but you'd expect to see a sharp depreciation in the event of the UK voting to leave the EU. But clearly, this is something that's on the Bank of England's mind and something they are continuing to warn against. The other event today was the Eurogroup meeting, and again, the key point at the top of the agenda here is going to be Greece and getting Greece the next tranche of its bailout, as long as Greece complies with the demands of its creditors in terms of reforms and tax hikes. Now, we saw over the weekend that Greece actually passed the latest batch of unpopular measures to the annoyance of the Greek people. We saw protests as a result of this, things like tax hikes and other measures, things like VAT, for example, in order to try and get the next tranche of the bailout, in order to try and meet debt obligations to the IMF and the ECB, among others, in July. Now, the other reason behind passing these unpopular measures, which previously Alexis Tsipras and the Syriza party would have been determined to avoid, is the fact that one thing on the table now is going to be debt relief talks. Now, this is going to be a very big issue for Greece's creditors, because there's a significant amount of disagreement between the IMF and the European Union about how this debt forgiveness should be applied, and whether it should be applied at all. For that matter, the IMF have clearly indicated that there will be no deal without debt forgiveness from their part, and they didn't want to be part of a solution that didn't include debt forgiveness, because anything that doesn't include debt forgiveness is not sustainable in the long term. But still, ministers do seem relatively optimistic. Valdis Dombrovskis, Latvian politician who is the European Commissioner for Euro and Social Dialogue, claimed that there's hopes for an agreement in principle on Greek reform programme, and finance ministers to discuss debt relief in order to ensure they get IMF participation. This was echoed by Jerome Dijsselbloem as well, who's the Eurogroup president. But of course, we've heard comments like these before, and the sticking point at the end of the day is not going to be Dijsselbloem or Dombrovskis. You'd have thought it was going to be coming from Angela Merkel's camp, because as we know, Germany is very opposed to any form of debt forgiveness. So it's a case of how can they do it in such a way that they're not selling it to the German people and other countries as well, of course, as forgiving Greek debt, as opposed to easing the terms and conditions on Greece in order for it to have a sustainable package in place that will enable it to grow, continue to grow in the future, and for the economy to eventually improve, something that hasn't been possible up until this point. We're unlikely to see really in the near future. Going into the end of the session, we do have a couple of more pieces of data to come. We've got new home sales from the US, and we've also got API weekly crude oil stocks, which are becoming increasingly influential in the oil markets over the past couple of weeks. We had that small drawdown last week, likely due to some of the outages which we have had in global oil supply, and it wouldn't surprise me if we do see another one like this again. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.